war between Iran and Israel after Israel's sort of unsolicited, unprecedented, unprovoked attack last Friday. And since then, we have had a climb up in oil prices, a jump of 12+%, and then sort of plateauing around the $74 mark, 73.43 this morning. And at least from an oil market's point of view, they're sort of indicating nothing much to look at here. Let's kick off this morning with Clyde Russell, Asia commodities and energy columnist from Thomson Reuters. Clyde, you yourself penned an op-ed here today, published, I believe, today or maybe late yesterday, indicating that no disruptions to oil supplies in the Gulf, no panic. As Captain Mannering used to say, no panic, no panic. Your thoughts, Clyde, is this a moment for the markets to panic? Are they asleep? Are they nonchalantly marching to the edge of a cliff? Your thoughts?
Well, I think what we've seen so far is a sensible pricing in of some new risk. Certainly, anytime you have planes flying around the Middle East, bombing and missiles going and whatever, that does ramp up the geopolitical risk. But as I pointed out, the important thing to notice is, as yet, not one barrel of oil supply has been lost. And this sort of continues a pattern we've seen at times of heightened tensions in the past. There is, maybe even, an actual shooting war going on, but oil still miraculously flows out of the Gulf. And so far, it seems to me that both sides are being actually pretty careful in not targeting anything that would affect crude oil exports through the Strait of Hormuz. So on that basis, I think the market is now in a wait and see type of mode. If you did get to a point where Iran loses its rationality and tries to close the strait or at least disrupt shipping through it, or the Israelis decide to attack Karg Island or something like that, well then yes, the premium would have to rise and rise substantially. But at the moment, we're not there.
Good morning and welcome to Anup Singh, Global Head of Shipping Research at Oil Brokerage in Singapore. Anup, I'm wondering, there's been a lot of reports over the last 24 hours, most notably from the United Kingdom maritime trade operations in terms of kind of official announcements, acknowledging that the level and intensity inside the Gulf are having significant impact on vessels positioning, reporting through automated systems, that basically the GPS of the shippings is being jammed, and in a sense ships are driving blindfolded, and we've had reports now this morning of a collision of two oil tankers off the coast of the UAE in the Indian Ocean outside the Straits of Hormuz. So ultimately my question to you, Anup, is could this amount and escalate in time to essentially be a de facto closure of the Straits of Hormuz if shipping becomes so dangerous to the extent in which not the bombs but the GPS will eventually make it sort of aligned with shipping requirements?
Yeah. So I think there is merit in saying that this is disruptive. I don't think it amounts to a closure, or it is tantamount to something bigger than what it is. Ships are transiting the straits so far, and the collision has happened well outside this area, which is very much in the middle of the GPS jamming story, which is off the port of Bandar Abbas, and therefore very much north of where the collision has happened. Unfortunate timing of the collision, and therefore with all the newsy pieces to it. I think what's the other aspect to look at?
So you think that's just a coincidence? You think that's just a coincidence? Not
at this stage. I'm inclined to believe it's a coincidence. It's a bad timing. There's no good timing for collision, but this is a timing where it can create mixed signals. Yeah. But I think the other aspect around whether this is as bad as it gets. Your poll was quite instructive, where there's an almost even split 42.58. Not almost even, but yeah, there's a fair bit of people who think that this has more legs. Yeah. And if you look at if you're a ship owner, for instance, right, and you're looking at going into the Gulf, if you are a company which is listed on the U.S. stock exchanges or a Western company, things might look all right now, but could deteriorate very quickly and unexpectedly. So will you get the insurance cover you need if you're trapped in an unfortunate position? So those are the considerations which will also keep ship owners hesitant. And therefore, even if in the immediate 3, 4, 5 days we haven't seen a single drop of oil not being permitted to leave, I don't think you can from here extend that this is the end of the impact on oil markets.
Well, just on the point of the GPS jamming of the ship navigation equipment, is that a familiar sort of impact? I know we've had the Dark Fleet turning off their GPS in recent years because of the needs to avoid sanctions and so on. On this occasion, is it a sort of a de facto, just a consequence, an unfortunate consequence of so much military activity in the region that this is just an unintended sort of collateral damage, as the word goes, in more horrific circumstances, or is this a targeted thing to disrupt Iranian oil flows and so forth?
Hard to say why this is happening. Ships can navigate without GPS. It's a coastal water, so with radars, the conventional ways of navigating still exist, so you could still navigate the channel. So there is an alternate. And there's always some element of GPS signal jamming in that part of the world. Every time you have a heightened risk, you have some element of GPS jamming. Why it happens? Well, there could be many reasons. It could be some rogue elements within the establishment. It could be a concerted attempt to limit the abilities of foreign navies, degrade their abilities. That's possible. And there are myriad possibilities, I think limited only by our imagination.
Yes. Nonetheless, it's happening. And I suppose if you add that up to the insurance concerns and ship owner concerns, it just layers on to another concern. And I suppose my question ultimately is, as these concerns stack up, that if indeed, this sort of dreaded the closure of the Straits of Hormuz, which is always the sort of bang bang headline, but ultimately the accumulation of these things, these elements, stack up to the point at which shippers will refrain from traversing these waters, and it becomes in time perhaps just a de facto closure without it necessarily being an intended one. And that's just a rhetorical question. That's kind of where I'm coming from. Let's welcome Ole Hansen, Head of Commodity Strategy at Saxo Bank. Ole, looking at the wider dynamics here, your thoughts on what I would sort of generally regard it as a fairly muted response from the energy markets to this incident. I mean, would I have to acknowledge one of the world's largest LNG exporters, Qatar, literally, some miles away from the closest hit from Israel on the South Pars gas installation on the Iranian side of the sea there. While the UAE has exit routes for its oil through Fujairah, and Saudi Arabia has exit routes for its oil through the Red Sea coast, Qatar, one of the world's largest exporters of LNG, does not have any alternative. Your thoughts of the calmness of the energy markets reaction thus far to this 5-day war?
Simply, I believe it is what Clyde highlighted as well, and through his update, which I think is really worth just highlighting once again, because there are so many vested interest in this not escalating to impact crude and gas supplies going through the Strait of Hormuz. Also, who would Iran hit by closing it down besides themselves? So they desperately need the revenues. So with that in mind, and also considering India and China being the biggest customers for Iranian crude and for crude from the Gulf in general. There's just simply no interest in closing it down. So that's why I think yes, the market responds to the risk, but I think it's also a risk that has to be considered minimum. I'm sitting here in Copenhagen. Obviously, I'm thousands of kilometers away from the event, so I'm probably not the best one to ask. But just looking at the realpolitik of politics of things, I would be very surprised to see any further escalation. But it also highlights the binary outcome of this once again, because crude oil, yes, were on a move higher when before this broke out, because there's some summer tightness that will alleviate into the autumn months, but it was hitting a market at a time where there was already some tightness and prices were moving higher. But generally, I'd say without this war threat, or without this threat to supplies, we should probably still be trading back below 70 in Brent, so and potentially above 80 if it's not the case. So that's why we have a binary outcome, which just highlights this, adds to this volatility we have right now.
Clyde, looking to Asia here, we were talking yesterday, so much of the narrative is about how the West is reacting in the G7 meeting in Canada and so forth. And yet Asia is really the biggest customer to all of these potentially threatened energy supplies. How well placed is Asia? They're very quiet. The silence is deafening, so to speak, in the terms that they are perhaps the biggest losers, if indeed any of these endless possible errors, if nothing, not intention, but in a war, errors happen. And yet Asia is very silent. Are they just have just packed inventories? They've nothing to be concerned about?
I think there's an interesting sort of dynamic. I mean, Asia is made up of many different countries with different situations. Let's talk about China first. China, as we know, doesn't engage in loudspeaker diplomacy. They do everything very quietly, very much behind the scenes. So what they'll be doing is making their views known to all participants in the latest conflict, and just sort of saying it's not in your interest or in our interest for the oil to be interrupted in any way. That will be a very clear message that they will be delivering. If there is a major interruption and the worst case scenario, you lose 20 million barrels a day because the straits are closed, China can exist for quite a long time. They've got lots and lots of inventories. They'll be fine for a while. The country that's most at risk is India, which does not have a very large strategic storage. It would be in dire straits quite quickly. So there would be this massive scramble for oil from everywhere else if the worst did come to pass.
What about gas, LNG?
Well, you would lose the price of LNG would shoot up as well. What would generally happen is that your price-sensitive buyers in Asia would just simply stop. That would be India and China largely.
Because ultimately, you don't have the same depth of storage for gas LNG that you do have for oil, right? Across Asia and Europe.
No, you don't, but you do have substitutability. So even countries like Japan can substitute out LNG and burn coal. Yes, it screws up their emissions profile. So you've got the two North Asian big LNG importers in Japan and South Korea. They can switch to coal, or some switch to coal. China can stop importing LNG, not altogether, but it can really trim its LNG imports if it needs to. And you probably find that losing Qatar would obviously, that's the second biggest LNG exporter in the world. It would matter. But the world could probably adapt fairly quickly to it. Worst comes to absolute worst, you probably find that they would even lift sanctions on Russia's Arctic 2 project and allow that LNG to come to market if it actually did get that bad. The point is, I think we're still a long way from that happening. If you look at it, in all the past crises we've had,
the president did announce last night that a city of 10 million people should be evacuated immediately. And the oil markets didn't even respond. Let's go back to Anoop. Anoop, just looking at the shipping from the point of view of the elements that do stack up immediately, how does it impact? How does rates, tanker rates, the container rates, the markets react? Where's the insurance and such things? Do they shift at times like this? Does anything come into play? What's that looking like and the outlook for that?
So the impact, if you still want to see an ongoing impact, is still being seen in the freight markets, tanker freight markets. So while the Brent has sort of stabilized in the mid-70s, every passing day is seeing VLCC freight rates rise, MR tanker freight rates rise. So freight rates are reflecting disruption. Yeah, they're reflecting real disruption, and they're reflecting potential disruption, in the weeks ahead as well. It's not just happening within the Gulf, it's also happening in the Eastern Med. For instance, the Haifa refinery has been hit on the eastern coast. So Israel, all else being equal, at some point in time, want to get more imports of diesel. And so which ship owners will then be willing to call Israel at that point in time? So again, we're starting to see some stress emerge in the shipping markets in the Eastern Med as well. So, freight markets are still telling us a slightly different story than the oil markets are telling us. Oil markets, as you said, saying nothing to see, let's move on. Freight markets are saying, stop, there is a fair and real disruption, and we are having problems making decisions on how do we position our ships. And therefore, that element, the supply chain, the logistics element, is still very much in play, still very much disrupted. Yeah.
Ole,
Freight rates, yep.
Sorry, go ahead.
on.
I was just going to say, Ole,
Yeah.
I'll just move
Of
to Ole here on the wider commodity market. I mean, one of the things that sort of is in the narrative of the G7 meeting in Canada, and if there is some pressure to bring to bear if the G7 nations would feel the heat from the potential for inflation to reaccelerate because of this event, and so they are incentivized to use whatever leverages they have to bring it to a close. Are we seeing that emerge in other commodities? Are we seeing a stress that the inflation could put pressure on the G7 countries to act? At the moment, statements seem rather muted. Israel has a right to defend itself. Iran shouldn't have nuclear weapons, but there doesn't seem to be any real action. They couldn't agree on a statement, it would appear, coming out of the G7 regarding the war.
Well, if we look across the performances so far this year, it really is a question of a lot of interest still for the precious metals, and that's clearly a sign that the world is the traders around the world are worried about several developments from geopolitical events to fiscal debt concerns, and obviously the potential impact on global economic growth with the tariffs impact. So with rising energy prices now being the latest sector to support this general strong performance across commodities, there is obviously a risk that we could see prices pick up in the short term at a time where we still, I would say, still really haven't seen the full impact of the tariffs, especially on the U.S. economy. So in the coming months, it will be a very one to watch what happens in the U.S. and obviously the whole battle between the White House and the Fed, how that plays out. But I think we're yet to see the full negative impact of the tariffs on the growth outlook. And if we do have prices picking up at the same time, that obviously does make it a challenging situation for central banks. But I think at this point in time, we are closer to a rate cut in the US than we are to a hike, that's for sure. And perhaps these cuts could become more than what the market is actually currently pricing in.
Clyde, looking at the wider lens on sort of supply and demand, as we see the latest data out of that OPEC's crude oil production only increased not even by half of the target set in terms of quota increases in May. The supply side is not what the quota increases have been announced, and the ability of producers to raise to those new quotas, or perhaps they're already at them before the quotas were announced. But you're looking at that supply-demand balance. Is this market tighter because of those basic fundamentals that we've had the OPEC announcements, but actually the increases have been limited, and yet demand in Asia and particularly China remains reasonably strong?
Well, I think there's quite a bit to unpack in that. Yes,
Yeah.
I think it's harder to turn on supply, just like that. It's not just simply opening a faucet and oil flows. So I think we are seeing that. Does this mean that OPEC or the OPEC Plus group won't actually, start increasing their output and making that oil available? Yes, I think they will. I think they've been quite clear about that. But it's probably going to be a several-month process rather than, next month they're going to hit those quotas exactly. Don't see that happening. I'm still basically confused by the whole narrative that demand is quite strong. The Chinese have been buying oil, certainly in the last couple of months, yes, and looks like June will be quite strong, but they're not refining it, they're storing it. So yes, it's real demand in the sense that barrels are physically flowing to China, but in a way it's also kind of fake demand because that oil is not being consumed, it's not being processed, it's being put in storage tanks. Why are the Chinese doing that? Well, because from about February down to fairly recently, you had a declining oil price. They always tend to buy when the oil price is cheaper. Now that oil prices are rising, I expect that by August, once you get work in the 2-month lag from when cargoes are arranged and when they're physically delivered, you'll start to see Chinese imports start falling again. And then the world will be like, oh, maybe demand isn't that strong. It's a kind of weird dynamic. It's you can almost chart a price versus import graph in China, and it's really, really good once you work out that 2 months lag of when cargoes actually physically move. So I'm not convinced that there's huge demand growth, especially in Asia. I'm seeing a little bit of uptick in India. I'm seeing the other big consumers, Japan, South Korea, Indonesia, they're all pretty flat. So, if the market is tight, it's not on a demand side, it still can only be on a supply side.
Let's go to the survey question on the sort of earlier point, which is looking at the scale of disruption to shipping inside and outside the Straits of Hormuz from GPS jamming could amount in time, not immediately, to de facto closure of the waterways. That if the GPS jamming continues to escalate as the conflict escalates, could it in time amount to a de facto closure of the waterways? Agree or disagree with that statement? Anup, just picking up on Clyde's point there, I mean, one of the things we're trying to get a handle on is that where is this, we've seen a 10+% climb in oil prices since a week ago when the US government first announced plans to withdraw non-essential staff from the Gulf, and then obviously the conflict started and we're deep into it. So the fact that no oil supply disrupted yet, is this oil price going to stay elevated because there's a tight market, it's summertime, US demand is up, etc., or will this balloon deflate as the market gets used to this conflict and the reality that no oil is being disrupted, and we'll go back to the sort of $65 handle? How tight is this market from a demand point of view in Asia, and are we seeing that reflected in rates?
From a rate standpoint, this is typically the weakest point of the cycle. We call it the summer lull because ship owners, because of the timing lag, refiners tend to buy early, and by now they are reducing the imports. So we are typically at a seasonal lull for shipping demand, and therefore rates where they are, the strength that they've shown, and even across the curve they've risen on the forward curve. So Q3 is up, Q4 is up, even Cal 26 is up. We would argue Cal 26 has not reflected the level of potential risk that this conflict carries. Now, in terms of how are the oil markets, have they got used to it? It's, even shipping markets and both oil markets are very, very now headline driven, news driven. And a lot will depend on what's the next headline. A lot will depend on, is there some merit to Trump's statement that, Tehran should be evacuated? So what's behind it? Is there something massive coming down the line tonight, tomorrow? Does it mean that a big air attack or something more targeted at the regime, or regime changes? So there is so much up in the air, that it's hard to really say that everything that can happen is currently priced in. I think there is too much of uncertainty, and therefore prices can only reflect, an average outcome. There will always be people who are more right than wrong, and they might be the minority, and they might be the ones who are going long rather than shorting the market there.
Ole, looking at the European narrative, we had, in all the noise, as Anup mentioned there, the reports out of the G7 that Trump is uncomfortable elevating the sanctions on Russia. No surprise, perhaps, but there has been a lot of reports that the U.S. Senate were preparing fairly aggressive sanctions on Russia if they didn't come to the table for advancing peace negotiations with Ukraine. Your thoughts there on where the Europeans are at vis-a-vis unloading, curtailing Russia further, not having America's cooperation in that? Is that likely to make any additional sanctions redundant?
Well, the additional sanctions, I would say, without the support from the US, will probably not have much weight. And also, really, we've seen now for the last 3 years that Russian oil flows has managed to find a buyer, no matter what obstacles has been put in place. And I don't see any change to that. So it's a tried attempt, but I wouldn't say that it's been a successful one. So whether it's 60 or 50 or 45, I don't really think make any difference in whether Russia can get its oil to the market or not. There will always be a buyer if the price is low enough.
But on that wider point, any resolution of the conflict in Europe, it seemed we spent much of the first half of the year thinking that it was relatively imminent. We end the first half of the year sort of feeling that this is going to be bedded in for another while, that the US effort to resolve here seems unsuccessful.
Yeah, it seems like Trump is losing interest. He didn't manage to secure peace overnight, and now he's getting frustrated, and he wants to move on to something else, maybe making a Trump phone or something like that. So it's really difficult to see a solution to the conflict anytime soon. So obviously that adds some pressure on Europe to continue to step up their support. And with that in mind as well, we are heading for potentially another winter where obviously the gas supply will be in focus, and the need to refill storages before we get to the winter months.
Let's just wrap up with a around the table view on whether we have seen the peak in oil market reaction to this conflict without impact on oil supplies, and that it would now take something very definitive in a disruption in order to move to yet another level. Like we saw after the Russian invasion of Ukraine, prices popped right above 100, big jumps. We haven't seen that on this occasion. Your thoughts that peak reaction is over and we'll only see further if there's physical disruption? Your thoughts on that, Clyde, and we'll just go quickly around the table.
Yeah, indeed. It will take something new and big to shift the market from where it is. We're just in that wait and see mode.
Anup, your thoughts?
Yeah, I think this time it's different. I think the markets are underestimating where this could go.
And Ole, your thoughts?
I think we've been there so many times before. I do agree this is probably the worst one we had for a number of years, but I still think there's so many interest in keeping supplies going that I would be surprised to see an additional spike.
Yeah, even in the worst of the Russian-Ukraine war, the gas continued to flow through Ukraine until last December. Of course, now it's closed. So it is amazing what can continue even in high conflict. Disagree is the result here that this could amount in time as the shipping disruption to a de facto closure of the waterways. I think it's worth watching as to the scale in which, it wouldn't take there to be one day no shipping and the next day, or the one day shipping and the next day no shipping, but the scale of the disruption, does that mean that ships with GPS jamming have to drive slowly, everything moves a bit with a lot more caution, insurance goes up, all sorts of different factors rather than it just being a lights on, lights off moment. And I think that's probably another factor worth watching. Thank you, guys. Really great to have your insights here today. Clyde Russell in Australia, Ole Hansen in Denmark, and Anup Singh in Singapore. Thanks, guys. Have a great week. All the best.
Thank you.
Thank you.